Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Welcome to the debate. Today is Monday, February 2nd, 2026. We are looking at the charts, we're looking at the fundamentals, and we are diving straight into the choppy waters of the consumer discretionary sector. Specifically, we're dissecting the smallest, yet I would argue, the most intriguing of the big three cruise operators, Norwegian Cruise Line Holdings, ticker symbol NCLH.
It's a fascinating, if somewhat terrifying time to look at this stock. If you were watching the close on Friday, you saw the red candles. NCLH stock closed the last session at $21.96, down 4.19%. We're seeing it in a heavy consolidation phase, and frankly, the market feels like it's just holding its breath.
It's definitely testing the nerves of the retail investor. But that brings us to the core tension we need to resolve today. The central question is really this. Is Norwegian Cruise Line Holdings a deep value catch-up trade that is coiled and, ready to surge based on its luxury market positioning and massive insider confidence? Or is it what the bears are calling a debt-to-equity colossus, a company so leveraged that it is simply too dangerous to touch in this specific macro environment?
Well, I'm taking the latter stance. I think investors are looking at the price tag and confusing cheap with value. I'm here to argue that despite the shiny new ships, despite the high-ticket prices, the balance sheet reality, specifically the leverage, and that massive debt wall approaching in 2027 makes this an incredibly high-risk asset. This isn't a dip, it's a warning sign.
And I'm taking the advocate position. I believe the market is fundamentally mispricing this stock based on legacy fear rather than current fundamentals. When you look at the yield generation, the specific charting the course strategy, and the fact that management is buying their own stock hand over fist, well, the sell-off is just overdone. This is a prime entry point for the contrarian.
All right, let's test that theory. You say it's mispriced. Lay out the bull case for me. Why should anyone try and catch this falling knife?
Because the value gap is becoming absurd. If you're a value investor, you're looking for a disconnect between price and reality. Right now, NCLH is trading at approximately 8.2 times forward earnings. Let's put that in context for a second. Royal Caribbean, the industry darling, is trading at roughly 18 times forward earnings. That is a massive, massive discount. The market is effectively treating Norwegian like a distressed asset that's about to go under. But the earnings power tells a completely different story. You're buying $1 of earnings for half the price of the competitor.
A low multiple is enticing, I'll give you that. But we both know that sometimes stocks are cheap for a very good reason. Usually it's because the quality of those earnings is suspect, or the market just doesn't believe they can sustain it.
But the quality here is actually superior to the peers. You have to look at how they make their money. Norwegian isn't just another mass market line like Carnival, where it's all about volume and cheap drinks. NCLH operates a 3-brand portfolio. Norwegian, which is contemporary, Oceania, which is upper premium, and then Regent 7 Seas, which is pure ultra-luxury. That spans the entire spectrum.
Sure, they have nice ships, but does that actually translate to cash?
It absolutely does. The data proves this strategy works. They command the highest gross revenue per passenger day in the entire industry at $390.37. Now compare that to Carnival Corporation at roughly, $236.54? They are extracting significantly more value, nearly 65% more, from every single customer that steps on board. They are the yield kings of the sector. They aren't just filling beds, they are filling them with high net worth individuals who spend heavily on board.
I grant you the yield quality, they get the rich customers, and Regent is a fantastic brand. But let's look at the other side of the ledger. You talk about revenue per passenger, which is great, but there's an old saying on Wall Street. Revenue is vanity, profit is sanity, and cash is king. The sanity check here is, it's alarming.
Here comes the debt argument.
You bet it is. NCLH has a net leverage ratio of about 5.4 times. For our listeners who don't spend their days in Excel, that means their net debt is nearly 5.5 times their annual earnings before interest, tax, depreciation, and amortization. That is a heavy, heavy backpack to wear while climbing a mountain.
It's high, I know, but it's coming down. They are deleveraging.
But look at the peers. Royal Caribbean is sitting comfortably in the mid-2x range. Norwegian is lagging the recovery curve by years. So while they're celebrating high ticket prices, they have this massive hurdle approaching. We're looking at a $3.4 billion debt maturity wall in 2027. That is right around the corner. They're currently paying about $700 million a year just in interest expenses. That's dead money. It doesn't build ships, it doesn't hire crew, it just services the debt.
Interest expenses are a reality of the post-COVID world for everyone in travel.
But for NCLH, it's suffocating. When you send that much cash out the door to bondholders, it absolutely crushes your net profit margins. Right now, their net margin is only 7.52%. There's almost zero room for error. If revenue drops even slightly, that margin evaporates and suddenly you're burning cash again.
You're focusing on the trailing financials, though. The market trades on the future. You're looking in the rearview mirror, while I'm looking through the windshield.
The windshield is foggy, my friend.
It's clearing up. And I want to address your point about efficiency, because I think you're missing the ROI-focused transformation that management is executing right now. This isn't the same company it was 2 years ago.
Transformation is a great buzzword. It's corporate speak for, we need to fix this mess. Where's the actual cash flow improvement?
Well, we're seeing it in the strategic shift to cut empty calories. Management realized they were chasing revenue that didn't bring profit. For example, they've drastically reduced participation in low-margin passenger air programs.
You mean subsidizing flights?
Exactly. They used to subsidize flights just to get bodies on the ship to keep occupancy high. It inflated the top-line revenue, sure, but it killed the margin. They stopped doing that. And yeah, that lowers top-line revenue slightly, but it cuts high-cost logistics expenses and boosts the bottom line. That is why they exceeded their Q3 2025 guidance on EBITDA. They are finally prioritizing profit over volume. The discount relative to Royal Caribbean represents massive upside if they simply continue to execute this specific plan.
I'd frame it differently. You call it a transformation, I call it scrambling to survive. You mentioned Royal Caribbean again. The disparity in balance sheets is not just a number on a page, it's a strategic weapon. Royal Caribbean and Carnival are deleveraging at a much faster clip. Carnival has reduced debt by over $10 billion. Royal is targeting mid-2x leverage. NCLH is hoping, and I emphasize hoping, to hit the mid-4x range by the end of 2026.
Hoping is a bit uncharitable. They have a clear path to get there.
A path that assumes perfect economic conditions. This catch-up trade you're pitching, it relies on the consumer remaining resilient indefinitely. If we see any softening in the economy, that 5.4x leverage ratio acts like an anchor. Because of that debt, they don't have the flexibility to lower prices or invest in marketing the way their competitors do. If a recession hits, Royal can lower prices to fill ships. NCLH cannot afford to drop prices because they need that yield to pay the bank. They're completely boxed in.
I disagree that they're boxed in. Look at the proactive steps they've already taken. In 2025, they refinanced $2 billion and eliminated their secured notes. That was a huge move to clean up the capital structure. It unencumbered the fleet. The risk premium the market is assigning is just too high given their actual cash flow generation. They are generating record revenue of $9.69 billion. The machine is working, it just needs time to digest the COVID debt.
Revenue is fine, but let's talk about where that money's going. This brings us to the debate of catalysts versus strategic risks. You think they can grow their way out of this debt? How? They can't just raise ticket prices forever.
No, they do it through high-yield strategic investments. The biggest catalyst, and this is something the market is really sleeping on, is Great Stirrup Cay. NCLH is investing $350 million to build a new pier and a water park at their private island, the Bahamas.
Which is a direct response to Royal Caribbean's perfect day at Coco Cay, so they're playing catch-up again. Royal has had that pier for years.
It's not just catch-up. It's an operational efficiency unlock. Right now, to get people onto Great Stirrup Cay, they have to use tenders. They have to ferry thousands of people back and forth on these small boats from the ship to the shore. It's slow, it's inefficient, and if the wind blows the wrong way, they have to cancel the stop entirely.
Which passengers hate.
Exactly.
It ruins the guest experience scores. The new pier eliminates that. It means the ship docks, people walk off, and they spend more time on the island. And more time equals more spending on drinks, cabanas, and activities. Plus, they're moving from a relaxation vibe to a multi-generational destination with the water park. This will drive yield growth significantly in late 2026. It turns a cost center into a massive profit center.
It is a compelling project, I'll give you that, but $350 million is a lot of capital for a company with this much debt. It's a gamble. And while they're building piers, the world isn't getting any safer. We have real geopolitical risks impacting operations right now. The Red Sea crisis is still forcing rerouting around the Cape of Good Hope.
Every cruise line is dealing with the Red Sea. That's priced in.
Yes, but it hits NCLH harder because of their margin profile. That rerouting adds 10 to 14 days to a voyage. That is a massive increase in fuel costs and supply chain disruption. It also means fewer voyages per year per ship. If you're Royal Caribbean with fat margins, you absorb it. If you're NCLH with thin margins and high interest payments, that eats your entire quarterly profit. And looking further out, you have the green methanol transition. They're redesigning ships for 2027 and 2028 to be methanol ready. That is necessarily for the long term, yes, but it is huge CapEx pressure right when they need to be paying down that 2027 debt wall.
But you're viewing that new capacity as a burden. I view it as the engine of growth. You have the Norwegian Aqua coming online in 2025 and the Norwegian Luna in 2026. These are immediate EBITDA boosters. The fleet is growing capacity at 4% per annum. These new ships have a richer cabin mix, more suites, more premium inventory. They are designed to be cash cows. You can't just look at the expense of the ship. You have to look at the return profile. The Aqua and Lunar are going to print money.
I just don't buy that the answer to a debt problem is buying more expensive ships. It feels like digging a hole to find a ladder. But let's shift gears to the people running the ship. You mentioned insider buying earlier. Let's talk about leadership and institutional trust. Is the captain worthy of the ship?
Oh, absolutely. You have to look at CEO Harry Sommer. He's a pure operator. He's been in the industry for 30 years. He steered the brand through the COVID restart, which was arguably the hardest operational challenge in the history of the entire industry.
No one doubts his experience. He knows how to run a cruise line.
But look at his alignment. This is crucial for anyone thinking about investing. His compensation is tied to EBITDA targets. In 2024, he received 200% of his incentive because they smashed their goals. And as I mentioned, he bought 25,000 shares in November 2025 at around $18.52. When the CEO, the CFO, Mark Kempa, and the directors are all buying with their own personal cash, it signals they believe the stock is in deep value territory. They're eating their own cooking. I mean, even members of Congress are trading it. Representative Lisa McClain was buying in late 2025.
Congressional trading is hardly a fundamental indicator, though it does add a layer of intrigue. I have no issue with Harry Sommer personally. He's capable. But I would argue that the macro environment overrides good management. You can be the best captain in the world, but if you're sailing into a hurricane in a leaky boat, it's going to be rough.
Calling it a leaky boat is hyperbolic.
Is it? Look at the ownership structure. NCLH is 83% owned by institutions. We're talking Vanguard, BlackRock, Capital International. This is a very crowded trade. If these big funds get spoked by a recession signal, the sell-off will be violent because there's no retail base to catch it. We saw Vanguard reduce their position by over 500,000 shares recently. The trust issue isn't about whether we trust Harry Sommer. It's about whether the bond market trusts the Fed. A 1% interest rate hike materially hurts their ability to service that $14.5 billion debt load, and that is completely out of Sommer's control.
The rate environment is stabilizing, though. We aren't seeing massive hikes anymore. But let's make this practical for our listeners. Let's put some real numbers on the table with a $5,000 investment scenario. If someone puts $5,000 into NCLH today at roughly $22 a share, what does that look like?
Walk us through your math.
Okay, let's look at the midterm projection, say 2 to 3 years out. Management has a target of $2.45 earnings per share for 2026. If they hit that, and the market multiple just normalizes to a conservative 14 times, which is still below the industry average and well below Royal Caribbean, the stock moves to roughly $34.30.
So the multiple expansion drives the price.
Exactly. That $5,000 investment becomes over $7,800. That is a 56% ROI in just over 2 years. That beats the S&P average significantly.
If they hit the target and if the market grants them that multiple.
And if you look long-term, 5 years plus, assuming they hit their 2031 revenue targets and the stock re-rates to its pre-pandemic levels near $55, that $5,000 becomes over $12,500. That is a 150% return. You are not going to get that kind of upside in Royal Caribbean right now because the growth is already priced in. Royal is priced for perfection, NCLH is priced for disaster. If disaster doesn't happen, you win big. It's the asymmetric trade.
That's a compelling argument, but have you considered the downside asymmetry? You're painting a rosy picture based on flawless execution.
I'm basing it on their own guidance.
Well, let's look at the bear case for that same $5,000. The stock has a beta of 2.26. That means if the market drops 1%, NCLH drops 2.26%. It is highly volatile. If that $18 to $19 technical support level breaks, perhaps triggered by a geopolitical event, fuel spike, or a missed earnings print, the technicals suggest a return to the 2024 lows. Analysts have a bear case target of around $19, but it could go lower in a recession. That $5,000 could shrink to $4,300 or less very, very quickly.
Stocks go down, sure.
But here's the kicker. Unlike a blue-chip dividend payer, you aren't getting paid to wait. NCLH pays no dividend. You are holding a volatile asset with zero yield. The risk profile is asymmetric, but not in the way you think. You need everything to go right just to justify the current price, whereas one thing going wrong sends it tumbling.
I disagree that you need everything to go right. At 8x earnings, a lot of negativity is already priced in. Even if they miss slightly, the stock is cheap. If they hit, it's a multi-bagger. But let's bring this to a conclusion.
Sure, summarize it for us.
For me, Norwegian Cruise Line Holdings is a high conviction buy, but, and this is important, it is for the patient investor. The luxury mix gives them a moat. The charting the course targets are ambitious but achievable. And the aggressive insider buying tells me that the people who know the most are betting on success. The potential to double your money exists here if the debt is managed correctly. And management has shown they're prioritizing exactly that.
And I remain skeptical. To me, NCLH is a show-me story. The debt wall in 2027 is a very real, very large obstacle. Margins are tight and operational costs are higher than peers. It is a high beta play suitable only for those who can stomach significant volatility. When I look at the sector, I prefer the safety and clearer balance sheets of the larger competitors. Why take the risk on the underdog when the leaders are winning so decisively?
That is the eternal question of the market. Growth versus safety.
Indeed. And looking at the technicals, we're sitting right near the 200-day simple moving average at $21.41. This is a critical pivot point.
It absolutely is. So, to our listeners, you have to weigh your own risk tolerance. Do you want the stability of the market leader, or do you want the potential high-yield pop of the company fighting its way back?
There is certainly more to explore in this material, and we encourage you to dig into the filings yourself.
Thank you for joining the debate.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.